Okay, good morning, everyone. We have 30 minutes, and I plan to use the last 10 minutes for comments and questions. So please start thinking about that. And good morning, John. Thank you for doing this. And one of your core research areas is monetary policy under uncertainty. And the word uncertainty is on everyone's lips these days. So let me start with this. What would be the implications of uncertainties on monetary policy? And what kind of strategy do you recommend to fellow central bankers who face greater uncertainties these days?
Well, first of all, it's great to be here. I thank Governor Ueda and the Bank of Japan are incredibly gracious hosts for this event, and it's been a great conference already so far. So in terms of uncertainty, you're right, this is the topic of the day, everyone's talking about it, but uncertainty has been around forever. Alan Greenspan famously said that uncertainty is the defining feature of the monetary policy landscape, and that was true when he said it some 20 years ago, and it's just as true today. And when I think about the future ahead of us, there's so many things that we're thinking about that create uncertainty for the economic landscape, whether they're fiscal policy, trade policy. You think about AI, globalization or deglobalization. So there's a lot of uncertainty out there. Now, one way I think about uncertainty is it doesn't tell you what to do in terms of monetary policy. Uncertainty doesn't tell you to be gradual or go fast or take small steps or big steps. I think what uncertainty helps you think about is how to best achieve your objectives, or you're thinking about monetary policy under uncertainty is about how do I best achieve my objectives in a world where there's a lot of uncertainty going on. And when I look back at the research that I and many others have done over the years, I think what you learn from that is a couple things. One is if you sit there with your models at home and you're running your computer simulations or calculations, optimal policy looks really good in a model. But one of the things that learned, I think every central banker kind of understands this, is that what's optimal in one model may perform very poorly in another model. And so you really have to think about robustness to the kinds of uncertainty that we face, whether it's about how the economy behaves, what are the shocks that you're facing, or maybe the parameters of your models, or however you think about it. So I think the first lesson around uncertainty is not to try to figure out exactly the optimal answer for a given forecast or for a given model, but really think about a approach that will work well across a multiple scenarios that you could be facing. And one of the things that I've learned in that analysis and from the research that others have done is, although it's true that trying to get the perfect fine-tuning solution can mislead you, can get you poor outcomes if you're wrong, you can find strategies that actually work well across a wide range of dimensions. And so, Athanasius and we work together, and many others have tried to figure out, well, what's an approach that does well across models? And so one of the things that I think we've learned from this is some forms of uncertainty are probably not as challenging. They're kind of symmetric forms of uncertainty. Maybe the economy will grow a little faster, a little slower, and you make the best decision you can. I think what the literature, from my point of view, has identified is some areas where the costs of getting it wrong can far outweigh the benefits of trying to fine tune. I'll give you a couple examples that I think are pretty relevant and have definitely come up even in this conference and many others. One is uncertainty about how do people form expectations. Of course, that's a topic everyone's talking about. And one of the things I've learned from working in this area is the absolute, not only in experience, but you see this in models, how important it is that inflation expectations are well anchored, and well anchored in a way that means that the shocks dissipate over time. They don't have shocks don't have long-lasting effects on inflation and on the economy. And so one of the things in the work that Athanasius and I have done with models with learning, for example, where people form expectations based on experience, the thing you want to avoid is allowing inflation to become highly persistent, because highly persistent can kind of become permanent. And the way to do that is respond relatively strongly to when inflation deviates from your target relative to, say, other factors. Also, strategies that make sure that inflation is, even though inflation can rise and fall for various reasons, that it doesn't become a very prolonged episode of inflation. And then the last example I'll give, which is near and dear to my heart, is the star variables. And I think the lesson from this literature is, there's a lot of uncertainty about R star, U star, Y star, actually the whole alphabet of stars. And when you think about that, if you have highly persistent changes in the economic environment that are hard to perceive in real time, those are like, in a way for monetary policymakers, they're like very persistent shocks. So going back to the comment I made on the work with Athanasius in our paper in the Brookings over 20 years ago, Athanasius, that paper highlighted the fact that misperceptions of R star, U star, Y star, these things can lead to very long-lasting kind of deviations from your target, which can, in a way, unanchor inflation expectations as well. And so you want to come up with a strategy that makes sure that you don't allow those kind of developments to allow inflation to become highly persistent. So when I think about this is you really want to avoid, from a risk management point of view, you want to make sure that you're protecting yourself from situations where inflation expectations can become unanchored, and the benefit of doing that is a relatively small cost on the other side. And I think about risk management in general is really a statement about where the costs are asymmetric to buy that insurance against the very bad outcome, and pay that insurance in terms of losing something on the other side. Now, one thing I will say is when you buy insurance, and we all buy insurance, we have car insurance, home insurance, life insurance, you often look back in the last few years of your insurance bills and you say, well, that was a lot of money I spent and never got anything out of it. And I think you have to think about risk management the same way. Sometimes you're buying insurance against something that doesn't happen. Ex post, you look back and say, well, I didn't need to do that. But to evaluate a risk management approach, you have to look at ex ante. What are the risks you're facing? And recognizing that, with luck, or maybe you won't have that bad outcome, but you're protected against it if it did happen.
Thank you, John. And as you said, the only certainty for monetary policy is that the world is uncertain. But well-anchored inflation expectation can perhaps make the world less uncertain. And you are a pioneer in inventing an approach to measure the degree how well inflation expectations are anchored. And yesterday, Governor Ueda mentioned, and as your research amply demonstrated, the inflation expectation in the United States stayed remarkably well anchored during the last episode of high inflation. But we live in a highly shock-prone world. And if another shock is to occur, what should we expect if the inflation expectation stayed well anchored for the first time? Can we expect the same for the second time? Or the second time can pose a rather bigger de-anchoring risk? How should we think about this?
Well, it's a really important, timely question, as you know, and it's one we don't know the answer. So obviously, it's an application of your first question of how do you conduct monetary policy under uncertainty. I mean, one of the things we have learned with models with imperfect information, models with learning, or other ways that people are perceiving what the inflation goal is, or perceiving what the reaction function is experience matters. And in one of the papers at or a few of the papers Athanasius and I did way back, we did some experiments. What happens if you get a sequence of high inflation shocks? Just bad luck. Well, what happens in these models is you can get this amplification mechanism where inflation expectations start moving more than you would normally do, say under rational expectations, and it has greater consequences. So I think to me, the lesson from this is history matters The fact that we had very low inflation for decades in the United States and many other countries before the pandemic, I think was hugely influential in how people formed their inflation expectations during the pandemic and hugely helpful. But to your question, I don't think you can take that for granted. The past 5 years have, I think, changed people's perceptions of the inflation, what can happen. I'll give you an example. The survey of consumer expectations that we conducted at the New York Fed, if you looked at the inflation expectations of the young, which means anyone younger than me, no, actually it means anyone under 40, they basically had never seen inflation. My kids, who are 31 and 27, have never seen inflation really in their lives. They were wondering what I was doing all the time, fretting over inflation, and their inflation expectations, not just my kids, but throughout our survey sample, was much lower than for all of us who are older. And during the pandemic, we've seen that distribution move up, and now it's basically the same whether you're under 40, 40 to 60, or over 60. So you've seen how that kind of mean expectation changes. You see how the uncertainty has risen pretty significantly. In the SCE, we ask people to provide probability density forecasts, and you see how that uncertainty has changed. So I guess my answer to you is, I think that this is different initial conditions in 2019. I'm not making a prediction of what that means, but I think we just have to be very aware and very aware that inflation expectations could shift in ways that would be detrimental. I would go back to the experience in the U.S., and I would agree with what you said. Longer-term inflation expectations didn't really move, at least to the measures I focus on. But we did see in the New York Fed survey, we asked people a movement in the 3-year ahead inflation expectations. That did move up in 21 and 22, 20 and 21, I should say. And that, to me, was starting to get concerning. 1 year ahead inflation expectations, that tends to follow inflation. It did before the pandemic. It did during the pandemic period. We saw 3 year ahead inflation expectations moving up, and that's not something you would want to see move a lot. And so I think that as you think about this, longer term inflation expectations, you want them to be anchored, but going back to my earlier point, you want the whole curve of inflation expectations to be well behaved. Now, that doesn't mean they don't move, because inflation has some persistence, but it means that they move in a way that has it converging back to target, back down to where it was within several years. So I think that, to me, I think that you can't take inflation expectations being well anchored for granted. You have to, again, from a risk management point of view, make sure that they do remain anchored, because I think that has been hugely helpful for us in achieving both our maximum employment and price stability goals.
So I suppose your children now appreciate their father's work fighting with.
Well, that's probably getting a little carried away there. But I do think, one of the things that people say that we were overly focused on demand shocks. Now, I'm older, so I guess I'm a little, we were focused on that because it's zero lower bound. But when I was studying, monetary policy and learning this from John Taylor as a grad student, it was all about supply shocks. I mean, back then we kind of assumed the divine coincidence, even if we didn't call it that. The demand shocks are pretty straightforward. It was the supply shocks that create trade-offs and challenges, and that's what a lot of the research on monetary policy of the past, up until the zero lower bound episode, at least for us, was focused on that. So I feel like this, resurgence of focus on supply shocks is not new. It's just maybe getting a better balance between focusing on supply shocks and the challenges, of course, with demand shocks when you're can be constrained by the lower bound.
You talked about supply shocks, and you also mentioned R star, Y star, and other stars at the beginning of your remarks. Well, you have been a pioneer in estimating R stars, and if we are to call the debate over R star the R Star Wars, I would say the composer of the soundtrack for that should certainly be John Williams. And you spoke in Sintra last year and argued that our stars in advanced economies tend to be influenced significantly by global common factors. And it might be the case that we are witnessing some changes in some of the global common factors. For example, if we are to deviate away from comparative advantage-based production and trade, would that affect Y star and R star? Or some people argue there is some symptom of changes in global capital flow and portfolio allocations. And if that is the case, would that affect R star as well?
Well, first of all, I think that you're posing the question in the way I agree with, which is you have to think about from a global factors. It's global supply and demand for savings, for investment. And R star, the equilibrium real interest rate, or however you think about it, is the the kind of equilibrium price that equates supply and demand for savings and investment globally. I do think that today a lot of the global factors that drove estimates of the neutral rate, say in the United States from about 2.5% to 0.5% in 2019, those are still in place. Demographics, relatively slow productivity growth compared to high productivity growth periods of the past. Again, I'm talking about globally, and other factors I think are still in place. So I think that the overall downward movement in neutral rates that we've seen everywhere, and I was in preparation for this discussion, I went to pretty much all the monetary policy reports to get an analysis, and it is striking because in the U.S. and Canada and Australia, estimates of R star typically maybe 0.75% to 1.25%. They're still way below the 2.5% that we had. But if you look in Europe, in Sweden, in Scandinavia, and Europe, you see estimates are closer to 0.25% or 0.5%, and then Japan closer to 0 or maybe even somewhat negative. So I think that from my perspective, we're still in a low neutral rate globally. That doesn't mean every country is in a low neutral rate, because I think national conditions in our economies can shift things. Last year, in the and that's I'm sure is on that video is available. So it was pretty entertaining discussion at Centra. We talked a lot about with AI and all these things that were going to shift up productivity growth and global growth, and would that raise R star? And the answer I would say is yes, if it happens. Today, that conversation I think has shifted a little bit with changes in globalization, with changes in trade policy. I think that can be an offsetting negative factor for growth that may bring down neutral rates. It's really hard to predict these things. It's very uncertain. My model estimate, my preferred model estimate for R star in the U.S. is 0.75 percentage points as a real interest rate. I think that's consistent with what we're seeing in some other advanced economies. Our estimate for Europe is actually about 0. A little bit negative for the euro area. So that's my kind of view. I think that we'll have to see how these different factors will fold out. It could be a little bit of a battle between, does AI increase productivity enough that offsets some of these things? We'll have to wait and see. It's just the data, we don't have the data to support that yet. I think that the important point for me on this is there's a lot of uncertainty about these neutral rates, absolutely. And I wouldn't put all my chips on an estimate of this. But it also means that you can't say, I think with confidence, that we are away forever from the lower bound. We could find ourselves, when I say we, I mean globally, whether Europe or countries around the world, we could find ourselves in a situation with big enough negative shocks that we are constrained by the lower bound at some point in the future. For the U.S., that's clearly not the situation today, but I'm talking about more conceptual.
Well, I hope that wouldn't happen, but yesterday, Annette made an excellent presentation on the supply and demand of central bank reserves, and you're also a pioneer in that field as well. And in early April, we have seen a period of market volatility, and traditional safe haven asset didn't necessarily perform as typically expected. But the money market largely stayed calm. And some people argue that abundant central bank reserve helped that. Do you agree with that? Is there any implications on the desired level of central bank reserves?
Well, I think it's a really good point you're bringing up. First of all, there was huge shocks to global financial markets and to the U.S. Treasury market, foreign exchange markets, equity markets during April due to announcements and discussions around trade policy. What we saw, I think, were two things: a lot of volatility in those markets, but market functioning continuing every single day. So we didn't have a market dysfunctioning event. Thankfully, this was more about markets absorbing kind of the news and figuring out what it would imply. One of the things you definitely saw in April was a lot of flow, between buyers and sellers. So people were saying, maybe I want to sell these assets, and other people saying, but I'll buy them. So the market was working, price discovery was working. That's very different than March of 2020, when it was basically a one-way out of, dash for cash. So it's just a very different situation in that work. In terms of what we learned about ampleness or abundance of reserves. So first of all, you should say that the level of reserves in the U.S. is clearly abundant still in the diagram Net showed, and we look at a lot of metrics for this. We look at a lot of indicators from the Fed funds markets, from repo markets. We do our own econometric analysis. All of them are saying that we're still in abundant reserves. I think one of the things that we learned, and I'm not arguing for a definitive answer, is that when you get big shocks, and your unanticipated shocks, it's really nice that there's a buffer there that can absorb that. So the repo market didn't show any stress during this period, and the short-term interest rates were locked in. So I think that, to me, an argument that having somewhat of definitely having ample reserves and having a buffer there can protect you not only against the shocks you kind of expect to happen, which happen for normal reasons, but for the things you just didn't see happening. So we had no issue in the repo market, no issues in kind of unsecured markets either. So I think that that's just a reminder that the approach we're taking, I think, is very sensible.
Okay, thank you, John. So now I would like to open the floor and invite Agustin, please.
Well, thank you very much, John, for this very interesting conversation. We have been talking about uncertainty, and I want to see if you agree with me on this. I think that central banks in general, autonomous central banks, have been key to sort of counterbalance the enhancement of uncertainty. I mean, imagine a world without autonomous central banks. Imagine, the typical poster case for political cycles is a new government comes and changes everything. So imagine the world we're living today if we were in a world where the new president could redesign the Fed or influence its monetary policy stance as it can affect monetary fiscal policy or other policies. So my point is that today we are sort of, and I think we should talk about this, we're living a situation where just by existing as an autonomous central bank, central banks are making a huge contribution to put sort of a lead, not absolute, but an important lead on uncertainty, and I think we as a collective body should make this point, because I think it enhances the value of central banks' independence. I would think it would, especially this issue that by institutional design, you have the people designated for multi-year terms. And the terms of many of you, all of you, I guess in the board is the vast majority. It transcends even the term. So I think that we should, precisely in cases like this, try to remind in a careful way society in general that the Fed is doing its job by design, So I think this is something I I would try to do it personally, but I don't know if you share this view.
Well, I mean, it's obviously it's like you said, it's not just the United States. It's virtually every country, has independent central banks now, and the reason we have independent central banks is, I always say this is not because we like it, or that it's comfortable or pleasant. It's because it's proven to work well, and it's proven to provide strong support for price stability in the countries around the world. And we have institutional structures, as you point out, that reinforce that in terms of whether it's terms of terms or and all of that. I go back, though, to a longer history, especially in the Federal Reserve. I joined the Federal Reserve in 1994, and while I was interviewing, it's kind of like this pivotal moment. While I was interviewing for a job, the Fed didn't even issue FOMC statements. That was early '94. By 1994, we started to issue statements. I think we've done over these past 30 years, and led by Chair Greenspan and Chair Bernanke and Yellen and Chair Powell, all throughout this period, have really taken seriously the two kind of pillars of transparency and clarity around what we do and what our mission is and how important it is, having a 2% inflation target, communicating that effectively, and also accountability around that. So I've seen 30 years of the Fed, I think, building very intentionally in a very strong way the transparency, the accountability, and around all the things you're talking about. And I do think we have a relatively limited mandate for monetary policy, maximum employment, price stability. Those are huge things, but they're relatively narrow, and we need to focus on delivering those in a way that best serves the American people and, quite honestly, I think the global economy.
Okay. Other comments, questions? Yes, please.
Yes, this is regarding neutral rate estimation, or ARSTER. We are user of your HLW model for estimation neutral rate. Now, for emerging market economies where constant flow of FDI we observe or we witness, there we see that in long-term exchange rate appreciation or depreciation. Especially for India, we see a long-term appreciation. So in your estimation of ARSTER model, do you think that apart from growth in potential output, we should consider exchange rate appreciation also? Otherwise, it will always overestimate ARSTER for emerging market economies.
Right. That's a really important question, because I've spent much of the last 25 years trying to dissuade people from using the Laubach-Williams model for the U.S. economy, for other economies, without doing that careful thought. Like, if you're an emerging market country, you're a small open economy, you want to think carefully about what are the dimensions of aggregate demand, price determination, whatever it is that's relevant for your economy, and think about that. When we did this, we went through a lot of that work about deciding which variables to include, which not, broader financial conditions, for example, rather than just the short-term interest rate. So we did a lot of work on that to make it work to seem appropriate for the U.S. economy. So I think when you think about emerging market economies, where obviously the exchange rate is a very important aspect of the inflation process, for the demand process, I think these are absolutely right. It's kind of like the DSG models. One unfortunate thing is, economists come up with these models that are designed either for U.S. or maybe the Euro area, and suddenly they're being used, without, I think, the careful thought in other jurisdictions. So I think your point is well taken. I don't know how to appropriately do that, but it's a good point.
Okay, Yuri?
Thank you, John. I have a question for you about how would you deal with radical uncertainty, something we don't have a lot of experience with. Like, COVID comes, we knew nothing how this can work. You have some war happening somewhere, we have very little experience with that. We have potentially AI completely changing the labor market in many sense in the economy. How would you think about the unthinkable?
Yeah, well, we did have to do that. And your question was about as leading a question as I could think of. And that's exactly what we were facing in March of 2020. That's what we faced with Russia's invasion of Ukraine. These are situations that we had not seen in our lifetimes. You're going back to the history from 100 years ago. You're going back to other experience. And that's where this risk management comes in. Because I'm just speaking for myself. Oh, by the way, I should have said that. Everything I say reflects my own views and not necessarily those of anyone else at the FOMC or in the Federal Reserve System. But I've said that a few times in my life. That's where the risk management comes in. In March of 2020, my concern, just speaking for myself, was an economy that was not going to recover quickly, that we could have deflation or a lot of very negative things, and you want to protect against that. Now, in the end, the economy did bounce back. In the end, we had the inflation. But I think from my perspective, there were huge tail risks to both sides. And the kind of determination is which risk you want to guard against. You can't guard easily against both. Now that changed. We saw the Russia's invasion of Ukraine, the effects of that on the global economy, and then you have to reassess kind of what's happening. And I think where, again, I go back to uncertainty doesn't say go fast, go slow, go big, go small. That once we realized the situation, the risks had gone, at least from my perspective, from downside risks and maybe a lengthy downturn to ones of an economy that's actually booming and demand is exceeding supply in the supply chain. We had to shift policy and do it pretty dramatically. So your question is, is the one I think we all have to think about is, and we heard about this yesterday, you can come up with playbooks. I think Andrew brought this up. You can think through these scenarios, but then when you're in the zero probability event, or events in this case, you're going to have to do this risk management. At the end of the day, you may look back and say, well, I was guarding against the risk that didn't happen, and if I would do it over again, I would do it differently. But that's what you have to do.
Athanasios, for the last question, please.
Thank you, and thank you both. What a wonderful discussion. I want to ask a question that relates to the first two questions we've heard today. When we're thinking about uncertainty, it of course influences the level of interest rates. It influences the estimates of R-star, emerging markets. We typically need to adjust for an additional risk. And there is an area of research that I know you've done some, but not as much, and it hasn't been discussed yet, which is how we understand risk premia in longer-term bond markets. And here's a question. One of the ways we can convince governments, to go back to Agustin's issue, about the benefits of having an institutional structure that supports an independent central bank with a narrow price stability benefit, is that with this style of institution, we can promote stability that reduces the long-term financing of government bonds by reducing significantly the premium. This is the same premium that would reduce estimates of R-star if done broadly. But we don't have quite the research to point to for that. Is there something based on your experience that you would ask the policy community and the academic community to look more into for evidence, for research, so we can strengthen this argument and promote the independence of central banks more forcefully?
Well, Athanasios, as you know, we actually have a three mandates, right? We have maximum employment price stability and moderate, I think, longer-term interest rates. And I think that gets to that. The view, and I think it's the Fed's kind of traditional Fed view, is if we achieve economic stability, price stability, that will reduce the risk premium, especially related to inflation risk in longer-term yields. It will bring down the mean level of yields with low and stable inflation. I think there is research on this. I mean, I'll put this in the broader context of my own research. With Thomas Mertens, I think we've looked at a lot of option pricing of bonds, and I think those clearly reflect distribution. I think this is my interpretation that the distribution of interest rates depends on the distribution of beliefs about inflation. So I think to the extent that very good monetary policy can reduce that uncertainty about inflation down the road, reduce uncertainty about the macroeconomy, it's to the best that we can. I think that does reduce the term premium, which is beneficial to the economy. I think the thing you can't do from a central bank is reduce the uncertainty, say around real rates, that's coming from other factors. So it could be supply side, productivity. We talked about that. It could be fiscal policy or things like that. So there are factors that you can't control with monetary policy, and they're determined by outside. But if we can deliver low and stable inflation and do that consistently, I think that does have the effects that you talk about. And I think that you're right. It would be good to have more kind of evidence and research on that. But I think, at least my view is that is an important channel.
Okay, there would be many more questions, but we've run out of time, so let's conclude this session. Thanking John for sharing